Let's now consider the building blocks of classical bar charting, trends and patterns. Trends first. It's apparent to everyone, you don't have to be a chartist to recognise the existence of trends in markets, the prolonged movement of a market either up or down. In principle, the trader's interest in such a trend is that they want to get in on one of those and get out before it breaks or when it breaks, and enjoy the profit, either being long of a bull market, getting in very early and getting out, or enjoy being short of a bear market, getting in early and getting out much lower down. Simply that. That's why traders are interested in trends. So they want to marry up the apparent obviousness of trends with the notion of getting in and out and trading them to make money. Chartists look at trends and want to define them tightly. And the reason why they want to define them tightly is because then they can be precise about when a trend has started and precise about when a trend has broken down. So if you can identify through charting structures when a trend has started, you can get in, long or short, and then when it breaks down, you can get out and secure your profit from having run the position along with the trend. So chartists need to be precise about the structures of trends, when they're being started and when they finish. Let's see how they do that. They do that, to cut a long story short, by So how do chartists define trends? There are two critical lines, two sorts of lines in defining a trend for a chartist. One is the diagonal on top of the bear trend, and this is called the bear trend resistance. And this is the line that keeps the market driving down. Whenever it comes back up to it, it forces it down again. That is the bear trend line resistance. The other line that chartists are interested in is the horizontals. In a bear market, from the lows, successive lows, and in a bull market, they're interested in the horizontals from successive highs. Let's look at these. So the horizontal. This is a horizontal resistance. So the first and most obvious line of structure, as chartists see it in a trend, is the diagonal, which is called a trend line resistance, that keeps forcing the market down. The general notion of a trend is higher high, lower. In a bear trend is lower highs, lower lows, succession of lower highs and lower lows. And the first thing that we look at is the bear trend resistance. And this is what you would intuitively recognize to be the most obvious part of a bear trend. The bear trend is lower highs, lower lows, but the defining thing is this line here, which keeps the market driving down. That's called the bear trend line resistance. But there's another line that chartists look at, and it's basically the line created by a prior low when the market drops through it. And this is a horizontal resistance from the prior low. The prior low resistance. And we can see here that these form a series of horizontals along the market, in the marketplace. And these, combined with that, form the structure of a bear trend. So we have the bear trend line resistance, and we also have these horizontal, the prior lows resistances. When a bear trend is in good fettle, the market fails at both this horizontal as well as the diagonal. Sometimes they combine, sometimes they don't. Here we have we don't combine. The diagonal is lower than the horizontal. It also follows that only when both of those are broken is the trend broken. So, for example, when the market rallied up here, if it had broken there, we'd say the trend was over. If this had broken here, we'd say the trend was over. But while it keeps going, both lines define. Which of the two lines is more important? Counterintuitively, it's the horizontal, not the diagonal, that's more important. Why? What's the reason for that? Is because the diagonal, when you're trading the market here, is this the more important line or is that the more important line? The diagonal is an extrapolation from historical levels. The horizontal is a precise level at which the market found support, and that is now resistance here. This is a level we know the market reacted at. In actuality, historically, this is an extrapolation from these levels here. This has no meaning historically in itself except as an extrapolation. Horizontals then are more important than diagonals. Let's look at a bull trend. Bull trends we know are broadly defined as higher highs, higher lows. Let's draw a series of higher highs and higher lows. The market is defined, the first thing is the diagonal that defines it, but in addition, chartists want to look at the support from prior highs. Sometimes they coincide, sometimes they don't. Horizontals are more important than diagonals in driving the market. So, for example, were this market to come down here and break here, would the trend be over? Probably not. The more important break is the one through this horizontal. That's when you'd say the trend was over. You may question, how closely does this sort of schematic approach to the structure of a bull or bear trend approach to reality? And of course it rarely approaches it precisely. Rarely. As I say, these rarely coincide. Typically the diagonal might be higher than the horizontal, in which case areas of judgment enter into the situation, and I'll spend quite a long time talking about the need to develop judgment. One way to analyse when a support is being, the importance of this line or that line, is of course the number of times the diagonal has been created. The more times that this market has bounced off the diagonal, the more important the diagonal. Another way is to look at the volume and open interest figures of when this breaks down through here. So let's imagine we have the volume and open interest here. At this point, what was the volume doing in open interest? Did the open interest dip? Did the volume rise? And if that was so, then we have a significant coincidence of evidence helping us describe what is happening here. Basically, the broad picture in trend terms of volume and open interest follow the trend. The trend breaks down when there's a rise in volume and a drop in open interest. Remember this, volume is the intraday price energy, intraday trading energy in the market. Open interest is the day-to-day trading energy in the market, the sort of energy that's left in the market when all intraday positions have been closed off, the overnight positions. This would suggest to me that long-established longs are closing their positions, and the volume would suggest that the higher the volume, the more significant the move. Basically, let me just talk a bit more about this. Volume and open interest should go up, volume up, open interest up when the trend is intact. When the trend breaks, if this is broken in low volume, it would be suspect. In high volume, very interesting. And a breakdown like this would be the intraday movement would be high volume, would make it interesting, and the day-to-day, when the market collapsed through that, you should see a drop in overnight positions with people closing their longs. In greater detail then, when a trend is broken, it's typically associated with large intraday. The importance of the break is established by the size of the intraday volume. And typically, if it's a long-term bull market, there will be a closing position of long-term bull positions. But if this bear trend was to be sustained, of course, the open interest would start increasing as people put on shorts, and the volume would increase as more and more people participate in the new bear trend. So an early indication of a faltering trend might be dropping volume and dropping open interest. And that might show that this trend is running out of steam. But on the moment of breakdown, there should be an increase in volume, daily volume, and a collapse in open interest as people close off their long-term longs. The broad point about volume is, when the market makes a move in whatever direction, unless it's accompanied by good volume, you should regard that move as suspect. So, for example, if the market had broken down there on very light volume, you'd be doubly interested in watching what it does here and wait for that move before you started considering the trend to be over. If it did that in high volume, you might consider the trend to be over already, particularly if volume and open interest have been dropping throughout this whole period. One thing that's worth considering is, and is very frequent in markets, is accelerating trends and decelerating trends and how we as chartists treat them. An accelerating trend can be simply represented by that. And what that's accompanied by is, of course, you start off with your first diagonal trend line, and then the market doesn't reapproach it. So you have another one, and then another one, and then another one. And you have this phenomenon of trend lines getting higher and higher. You have to redraw the trend line, because otherwise you've got nothing to spot to gauge the importance of this trend, because it's too far away from this trend line, so it's never going to be broken, and yet the trend will break down way before this initial trend line is broken. So that's why you redraw the trend lines in an accelerating trend. Obviously, the horizontals remain the same. So, for example, here we would consider, imagine this market had done this and broken there, we'd say the trend had broken there. Here, if this market had done this, we'd say the trend would have broken there. We don't wait for this to be broken. We don't wait for this level to be broken. We can see it's broken up there. So that's accelerating trends. Let's have a decelerating trend. Here's your first trend line. But when it decelerates, you have to draw another trend line. And when it decelerates again, you have another trend line. Notice that it broke this trend line, but it didn't break that. So you have to draw successive trend lines to cope with the deceleration. You still have to, even though it's breaking these diagonals, the critical thing is it's not breaking the horizontals. And you still have to keep drawing the diagonals, because they do add evidence for when the moment at which these might break. It is. This is yet another reason why horizontals are more significant than diagonals. But still keep redrawing the diagonals, because they will add in useful evidence for the crucial moment when it breaks down.